Listen carefully for a moment, because what just happened is not simply another geopolitical headline scrolling across your screen. It is the moment when a tension that had been building quietly inside the global system finally crossed the threshold into reality. Overnight, Donald Trump confirmed that the United States had begun major combat operations against Iran, alongside Israeli strikes targeting key locations in Tehran, including areas near the compound of Ali Khamenei. That announcement alone shifts the psychological architecture of global markets. Because when a sitting U.S. president publicly declares the destruction of another nation's navy and missile infrastructure as an operational objective, the market no longer interprets events as diplomacy, it interprets them as structural conflict. For months, tensions had been building beneath the surface: stalled negotiations, hostage accusations, military positioning across the Gulf. But markets rarely wait for confirmation. They price probability before reality arrives. Now the probability has materialized into action. This is why investors who only watch headlines often feel late to the story. The market is not reacting emotionally, it is recalibrating the map of power. And when power structures begin to shift this openly, what you are witnessing is not simply war unfolding, but the early signals of a world system preparing to reorganize itself. And once that process begins, the ripple effects move far beyond the battlefield. Now, here is where the situation stops being a localized military strike and starts looking like a regional system shock. Within hours of the initial air operations, Iran responded with ballistic missile launches targeting U.S. bases across 5 different countries at once: Bahrain, Qatar, Kuwait, the UAE, and Saudi Arabia. That scale matters. Because when retaliation spreads across multiple sovereign territories simultaneously, the conflict stops being bilateral and begins pulling the entire Gulf security architecture into the equation. At the same time, missiles were launched toward Israel, and the Houthi movement in Yemen announced the resumption of attacks on shipping routes in the Red Sea. 3 Gulf states quickly shut down sections of their airspace, not as a political gesture, but as a risk management response to a battlefield that suddenly stretched from Tehran to the Mediterranean and down toward the Bab el-Mandeb corridor. This is how escalation really works in modern geopolitics. It rarely unfolds in a straight line. Instead, pressure radiates outward through alliances, logistics corridors, and military bases scattered across the region. And when multiple theaters ignite at the same time, markets begin to interpret the conflict not as an isolated clash, but as a potential restructuring of security, energy flows, and strategic power across the entire Middle East. And that broader reaction is where the real market consequences begin to emerge. But the real pressure point in this entire situation isn't the missiles themselves. It's energy, more specifically, the narrow corridor known as the Strait of Hormuz. Roughly 20% of the world's seaborne oil supply, close to 20 million barrels per day, flows through that single waterway. For decades, analysts have called Hormuz the most important energy choke point on Earth. And right now, the market isn't asking whether ships can pass through it. The market is asking whether companies are willing to take the risk. Within hours of the strikes, several major energy companies began suspending shipments through the corridor. Tankers slowed, some halted entirely, waiting offshore while insurers recalculated war risk exposure. When energy logistics begin to hesitate like this, it sends a signal far beyond oil traders. It tells global markets that supply chains, the arteries of the modern economy, have entered a zone of uncertainty. This is why geopolitical conflict and commodity markets are inseparable. Oil is not just fuel, it is the operating system of global commerce. When its flow becomes uncertain, inflation expectations rise, currencies react, and investors begin repositioning into hard assets. And that shift in positioning is precisely where the story begins to move from the battlefield into the financial system itself. Now watch what the market did while most people were still processing the headlines. Because when geopolitical pressure rises, capital doesn't wait for commentary, it moves. Overnight, the gold-backed token PAXG surged toward $5,600 per ounce, briefly approaching its previous highs before stabilizing around the mid-5,400 range. At the same time, the physical market in Asia began sending a signal that was even louder. Spot gold quoted in China reached levels equivalent to roughly $5,560 per ounce, while Western spot markets hovered closer to $5,278. That difference may look small on paper, but in market structure terms, it is enormous. A $282 premium on physical gold inside the world's largest bullion market tells you something important. The physical system and the paper pricing system are no longer moving in perfect sync. And when those two layers begin drifting apart, it often reflects a deeper shift in trust. Trust in liquidity, trust in delivery, and trust in financial infrastructure itself. Markets are not just reacting to missiles or political speeches. They are quietly recalibrating where safety actually exists when uncertainty expands. And once investors start asking that question seriously, the story begins to extend beyond gold prices alone and into the broader architecture of how value is stored during periods of instability. But the more revealing signal isn't just in gold. It's unfolding inside the silver market, where the structure beneath the price is beginning to show strain. On paper, silver traded around the mid-90 range overnight, while Shanghai physical quotes pushed closer to $105 per ounce, leaving roughly a $12 premium between physical markets in Asia and Western paper pricing. That gap matters more than the headline price itself, because when premiums widen during a geopolitical shock, it often means buyers are prioritizing delivery certainty over theoretical pricing. Look deeper into the warehouse data. Reports tied to Chicago Mercantile Exchange show total silver in COMEX vaults near 360 million ounces, with registered inventories rising by about 2.3 million ounces while eligible supply quietly declined. At the same time, open interest collapsed from roughly 162,000 contracts to about 118,000, a drop near 27%, even as prices climbed from the low 80s toward the mid-90s. That combination is unusual. Rising prices normally attract more futures participation, not less. But when open interest shrinks while premiums expand and lease rates climb above 1.6%, it suggests something deeper. Confidence in the paper structure is thinning. The market is beginning to favor metal you can actually take delivery of. And when that shift starts appearing in multiple data points at once, it often signals that the underlying supply-demand story is moving into a new phase. Now here's the part many people miss. And it's one of the most important lessons markets teach if you're willing to pay attention. None of this appeared out of nowhere. The signals were already there days before the first missiles were launched. Oil, gold, and silver had been rising together in what traders call a lockstep move, a pattern that often appears when markets begin pricing geopolitical tail risk. At the same time, reports surfaced that China advised citizens to leave Iran. The U.S. State Department warned about Americans being taken hostage, and tensions around negotiations were clearly deteriorating. Quietly, more than $650 billion flowed into the global precious metals market, not because the war had already begun, but because informed capital was positioning for the possibility that it might. This is how markets actually function. They do not wait for certainty, they respond to probability. Investors who watch only headlines tend to believe events drive prices, but professionals understand that prices often reveal events before the public narrative catches up. The market structure begins whispering long before the news begins shouting, and when multiple signals, capital flows, commodity correlations, and geopolitical risk start aligning at the same time, it usually means the system is preparing for a shift larger than a single news cycle. And that realization is where the real strategic thinking begins. But here's where the market reveals something deeper about human behavior during moments of stress. While physical gold was surging in Asia and premiums were expanding across the bullion market, the so-called digital alternative reacted very differently. Bitcoin dropped sharply towards $63,000, and in less than 15 minutes, more than $100 million in leveraged long positions were liquidated across crypto derivatives platforms. That contrast is important, because for years, many investors have framed Bitcoin as digital gold, a hedge designed to perform during systemic uncertainty. Yet when real geopolitical escalation arrived, missiles, airspace closures, oil routes under threat, the market instinctively ran toward the asset with thousands of years of monetary history behind it. Meanwhile, physical gold markets across Asia were trading close to $5,560 per ounce, with premiums widening to nearly $282 above Western spot pricing. That divergence isn't just about price. It reflects how different financial ecosystems interpret risk. In moments of stability, technology narratives dominate the conversation. But in moments of genuine uncertainty, capital tends to rediscover older foundations of trust. Markets, in their own quiet way, remind us that safety is not defined by innovation alone, it's defined by durability. And once that psychological shift begins spreading through investor behavior, the implications extend far beyond a single asset class. Now the next chapter of this story doesn't begin on the battlefield, it begins when markets reopen. Western futures tied to the Chicago Mercantile Exchange and the COMEX have been closed while much of this unfolded, which means the real moment of price discovery is still ahead. But we already received a preview through markets that never stop trading. Tokenized gold like PAXG Gold briefly surged toward $5,560, while Asian spot markets quoted similar levels. Silver traded around the mid-90 seconds in Western references but closer to $105 in Shanghai, maintaining a persistent premium. When futures reopen, the probability of a gap move becomes extremely high. The real question is not whether prices jump, it's whether the paper markets can sustain those levels or whether large banks attempt to push futures lower to compress the physical premium. Historically, that battle between paper liquidity and physical demand has defined precious metals markets during geopolitical shocks. But here's what feels different this time. Officials are already warning that strikes could continue for days or even weeks, not hours. Iran has stated that there are no red lines, and multiple countries across the Gulf have already been pulled into the conflict. When events unfold at that scale, markets are not simply reacting to news, they are beginning to price a longer cycle of instability. And once investors start thinking in cycles instead of headlines, the entire strategic landscape begins to change.